Good afternoon, everyone. I'm Stacy Scott, and I'm here with you and with Graham Wickham, President and CEO of Wickham Financial. Okay, we're going to have to start over because I don't even know.
You're struggling with that from the get-go.
Okay. Good afternoon, everyone. I'm Stacy Scott, and I'm here with Graham Wickham, President and CEO of Wickham Financial and Insurance Services, and we're back with you for our weekly wrap-up. Graham, tell us what's been going on in the market this past week.
Yeah, so I think we got into the fourth straight rise in the equity markets in a row here last week. Now it was a bit muted because we had the holiday, right? But it was still a positive week. So we saw the S&P and the Nasdaq up about 1%, but we saw the Russell 2000 small cap index down about 0.5%. We did see all of the 11 S&P sectors higher. Now that was led by technologies, surprise, surprise. But I think more than not, I think the real hero here was healthcare. That's been the huge underperformer this year, and that was a part of the rally. We'll see if that has legs, right, going forward. We did see crude oil pull back about 5%. We on a good reason that we saw OPEC delay their planned meeting where they were going to be talking about additional cuts. We did see the U.S. Treasury yields decline modestly after a solid 20-year bond auction. If we look over the FOMC meeting minutes from the members, we still see that the members of the Federal Reserve are still concerned about inflation and how its stickiness is still around. So they still want to stay relatively restrictive. Not really a surprise to hear that. In other economic news, we saw the Confidence Board Index of Leading Indicators decline for a 19th consecutive month in October. We just saw overall tighter credit conditions and a fall in new orders. That was U.S. durable goods fell a good bit more than expected. We look over at November's consumer sentiment. Now that weakened a good bit the prior month, but came in slightly better than the preliminary estimate. Now this index has been below 75 for 28 straight months, I think it is. That's only been matched going all the way back to 2008 to 2010. So think about it this way, that's given you a really good clue that the consumer overall is just still really concerned, even though these markets and some few sectors in the markets and few stocks in the markets have done extremely well, maybe a little unexpectedly well. If we look at existing home sales, that fell to 13-year lows. We saw the median home price still rising, though, 3.4% year over year. And the average price is about $391,000, just a touch above that. If we go overseas, we saw China leaving the primary lending rate unchanged. I think a little bit of concern about some weakness that they're seeing in their own currency, the yen. Japanese core CPI, or the Japan, excuse me, not just Japanese, but Japan core CPI came in about 2.9%. Again, they want to be around 2%, around where our Federal Reserve wants to be for our targets. If we go all the way over to Europe and look at their central bank, I think their outlook, they made a statement of fragility. I mean, I think they're still really concerned about the financial stability in terms of how inflation could rear its head and play additional risk, and some concerns about additional downside growth in their economy and some of their economic numbers.
Okay.
Yep.
Well, Graham, what do you think that we can expect from the markets for the remainder of this year?
Yeah, I think we're in a seasonally strong time of the year. Historically, I've said that over and over again.
Right.
That still seems to be true. I mean, the market's levitating higher. I don't see any reason why the market probably has to take a big drop unless it's something geopolitical or some sort of, event we're just not thinking about that might rear its head. But I think the market could just drift higher going to the end of the year as we get into window dressing. We got some tax law selling. But then, Stacy, I think we need to be considering, and I think the market will as well, is what's worked and what's not worked next year, and possibly taking some gains in the stuff that's really outperformed and looking at some of the stuff that's been left behind, like the utilities and healthcare and the like.
Okay. Well, what advice do you have for investors as we wrap up 2023?
I think overall, don't kick yourself too much if you underperformed. It's a very concentrated market where I think you've had, 7-10 names have made up the majority of the gains in the market. If you weren't tech or had AI in your conference call, in your statements, you probably haven't had a huge outperformance or any outperformance at all. So there's huge swaths of the market that have underperformed. So stay the course, look for opportunities and weakness. You will get it. There's your opportunity to wait into some sides of the market that you feel like you're underweight. But be patient. Stick with your plan. Make adjustments around the edges. I always say around the fringes. Nothing fundamental in your planning strategy unless it needs to, because something fundamental has changed in your life. And then let's drift into 2024 and see how that goes.
All right. Well, thank you so much for that information, Graham. Thanks to our viewers for joining us today. And just a quick reminder, we have our monthly Lunch and Learn webinar scheduled for this Wednesday at noon, and we would love for you to join us. So make plans to see us on Wednesday and then again next week for our weekly wrap up. And until then, have a great week.
Take care.